certificates. Yeah.
Yeah, it sounds fishy.
It does. Yeah. Yeah. I mean, if you ever need gift certificates, don't send it to me. Okay.
Yeah.
Yeah. Good morning, Commissioner Starrett. How are you this morning?
Buddy, hi guys.
Good. Hi.
Morning.
Yeah.
Is Kit gonna make it on? I didn't remember if he said so.
Yeah, I think so. I just saw him next door.
Okay.
So I think,
Yeah, we're going to have a Jim Schlutfeld is not going to be here today because, which is really exciting, he's now sitting on some sort of board for the Federal Reserve down in San Francisco.
Oh, wow.
Yeah, so
We'll have some great information to share with
yeah,
everybody.
I'm afraid we'll lose him because if this is the same time, regular meeting for them, I think we would probably lose. So we're getting to sit on the Federal Reserve Committee and sitting on our committee. He said it's really been interesting. So you can be proud that one of our town leaders is having a voice down there and the Federal Reserve. He's an amazing man. We'd
yeah,
love to have him. My mind is blanking this morning. Kevin is also not going to be here today. He's flying somewhere. I don't know if it's for business or for fun, but we're not on. So it'll be Stacy in terms of the regular committees members. It would be Commissioner Bershauer, Stacy, me, and Bill Sweat. That's it. But we don't have anything we have to vote on, and I'm not certain that the quorum, when you talk about quorums, I don't know if it's the quorum of the minimum amount that could be present, which, in terms of the small, because we can have 5 to 7. So if we have 4 here, then that's a quorum easily on a 5-member board. If that makes sense to you guys.
Yeah, I think it's whoever's officially seated on the board. It's just the quorum of that number.
Oh, quorum of that number. Oh, so because I had read that we were increasing the number on some of the committees in order to get a quorum more easily. So I don't know if that would actually work if you have to increase the number that needs to be there. Anyway. So
I think it means our current board. In other words, who are our current board members, and that would be where we get our majority from, unless we chose to increase our number,
yeah, okay.
which we haven't.
Yeah, like the fair board, we just increased the number of
I saw, yeah.
members, but that's because a few of those folks are firefighters or they're in harvest right now, so it's just really hard to make meetings. And then when it comes to the fair, everybody's working, so it's hard to manage all of that with a smaller board. But
yeah. Well, that's an important board. A fair is important to our community. Anybody want to tell any jokes or sing or dance or anything? This is being recorded on YouTube, so all of this banter I will cut out. I promise you, it won't stay there. But it's there for now. I bet you those guys are standing out in the hall having a discussion about something. You guys have a lot on your plate right now at the county. Shall we start? What do you guys think? I think so.
Yeah.
Okay. All right. I say guys, but I say gals. you know, I read a thing is if you say you guys, that means you're from the West Coast. People on the East Coast don't say that. So,
No, I don't know. I think that's pretty universal. It's everybody, you know.
yeah, I think so. Yeah. Anyway, okay, well, welcome everybody. It's on our agenda. And the first thing we have, and I think we can do this, is approval of the minutes. I would ask that somebody, I assume that you've all read them in great detail. So what we need to do is to just get those approved. So Stacy, were you there? You weren't there, were you, last time? No. So there's Kit. This is going to end up being a commissioners meeting instead of a finance. Morning, Kit. Are you with us?
Morning, yes.
Morning, okay. So we were just approving the minutes, and if Commissioner Bershauer, since you were there and you're on the committee, would you mind suggesting that we approve those minutes?
Sure.
Make a motion.
Oh, go ahead.
I make a motion that we approve the minutes.
Well, you actually can't do that, Kit, but I appreciate it anyway.
Oh.
Yeah, I know, but it's really nice of you to do that because we needed that. Because technically you and Mary are not on the committee, but obviously you are on the greater committee. So, and formality has never been a big thing for me. So whatever. So are we all in agreement to approve the last quarter's minutes?
Yeah, I can move officially to approve.
Okay. All right, Commissioner Bershauer, you've moved in. So all in favor, say aye.
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 Aye. Okay. So now we get to
Can I
the,
just jump in here real quick, just for
Yeah.
Commissioner Johnston's edification? It's not that you don't matter, and it's not that we don't hold you in high regard, but you and I are sort of interlopers here. We're just spectators. We're not considered voting members. The only one with that great distinction is our chair, Commissioner Lindsay Bershauer. So we get to sit here and speak when spoken to, and we don't get a vote.
or speak when not spoken to.
Or
Everything's
speak when not
fine.
spoken to.
Yeah, everything's fine. And it's taken Mary a long time to just not audit, because you guys are so programmed to just jump in and say, you know, I approve or whatever. And so I've had to chastise Mary for several times. And she seems to be okay with that. So you're not the
Well,
only one.
What Commissioner Johnston doesn't know is we gave voting rights to that bear that's right behind him.
Yeah. So anytime that mayor wants to say anything, yeah. And of course, I've been on this committee now for years, and I'm still learning the ropes. So there we go. Okay, so what we have today is we have Stacy, who is incredibly knowledgeable about anything financial, is going to do well, it's true, you know it is, an overview of anything that she feels is important for us to know today. It's kind of wide open for her. So Stacy, would you like to, do you want me to?
Is it okay, Chris, if I share my screen?
Yes.
Okay. I put together just a few slides to go through, which are hopefully helpful in terms of some of the, can everyone see that? Okay, perfect.
I can.
All right. So I think just hitting on a couple of high level things, and I'll try to tie it back to, you know, maybe some considerations for the Yamhill County portfolio. But as I think you all know, since we kind of came out of the depths of COVID in 2020 and in this 2021, and as things started to recover, the economy started to recover, we've been dealing with an inflation issue. And as a result of higher inflation, the Federal Reserve has been increasing interest rates. And so I think that dynamic between inflation and interest rates has really been a key thing that my firm has focused on for our clients, and is certainly something that has impacted the Yamhill County investment portfolio, largely in some good ways, because we're earning higher interest now. There have been, as interest rates have gone up, there have been some losses in the portfolio, much of it unrealized, some of it Chris made the decision to realize and get into bonds and at higher yield.
No,
So if we,
I would just come in the back door.
oh, sorry, that's okay.
Kid,
So
kid, if you want to mute yourself.
He's
Sorry.
muted.
he is. So
I blame
some of the
Jody for
charts
that.
I'm
That's
gonna
Jody's fault.
No worries at all. Some of these charts that I'm putting up here are charts that were prepared by the company I work for, and I know it can be a lot of data, and I'm just going to hit on kind of the takeaways for the committee. So I think here on this inflation chart, the good news and the takeaway is that inflation has come down and is getting really close to the Federal Reserve's 2% target. This red line represents that 2% target. And you can see this darker blue line represents the core price, the PCE. And here they're merging in the latest reading. And so why is that important? It's important because if we see inflation coming under control, the Fed will have the ability to stop increasing rates. And while increasing rates have been beneficial, again, for the portfolio, given its ability to earn a higher rate, I think for your constituents, your small businesses in the county, your consumers who are trying to get mortgages, these higher rates are a headwind for economic growth. So that is something certainly I'm sure that the county is looking at too, just in terms of economic activity. If we look at where interest rates are, this is just a quick slide that shows how interest rates have increased since the hiking cycle started back in 2022. So right now, a summary, since that time, the interest rates have increased 11 times. So the Fed funds rate now is targeted between 5.25 to 5.5. And so I know, Chris, you've been reaching out and notifying the committee in terms of how the rates that you've been earning on some of the investments in the portfolio have been going up. And this is the reason why. As a result of that, though, rising interest rates, again, can be a bit of a headwind in terms of the value of the bonds you have in your portfolio. And if you think about, if you've bought a bond that's paying 3%, and then now there's bonds in the market that are paying 4%, all of a sudden those bonds that are paying 3% from the market's perspective are worth less. And so their price will discount in terms of, if you go to try to sell that bond on the market, that price of that 3% bond will go down in order to make it more equivalent to what the market conditions are currently at that 4% bond, which is why you're seeing, if you just look at these blue bars here, a lot of these are called indices, and their measurement of how fixed income has performed, and it's been negative. I think for the committee's purposes, Chris will go into the portfolio, but to the extent there are losses in the portfolio, it's because of this phenomenon of rising rates. And from the committee's perspective, I think, again, Chris can address this, but most of the times she's holding bonds to maturity, so that loss will not be realized. You'll get your par value back on the bond. It does mean, though, that you're in a bond that's currently earning less than what the market can provide. And so I think that's one thing I'll talk about in a little bit, is reinvestment risk. When you roll out of a bond, when a bond matures, what is the new interest rate that you can get? And is it at the same level that you are currently invested in, or have rates gone up or down? And I think that's something I'm sure that Chris is thinking about. What is the trend of interest rates and how that impacts what maturity of bonds that she's targeting for the portfolio. This is, again, a little bit technical, but I think it's important and to think about is what level of interest rate can you earn on different maturities within the bond market. And so we've been in this really weird situation recently where the interest rate that you can earn on shorter maturity bonds is higher than the interest rate you can earn on longer dated bonds. That's called a inversion, a yield curve inversion. And oftentimes it's a pre-indicator of a recession. Now, what it means for the Yamhill County portfolio is that if you look at how Chris has structured the portfolio, it's a very short duration portfolio and has some cash components as well. And it's been earning a very nice yield. And I think that has made a lot of sense because it hasn't made sense in the recent time period to extend that maturity out. And I know our investment policy has some restrictions in terms of bond maturity, as I recall. But I think that is, again, something that we're starting to see reverse a little bit as the interest rates have gone up more recently, that yield curve is normalizing. So what it means for Chris and the committee is that there may be a time where it makes sense to extend that duration out a little bit and you'll be able to earn some higher return. Just a couple more slides. I think this, one of the things, and I'm sure that our colleague who is engaged with the Federal Reserve is really involved in this as well, is thinking about what is the rates going to look like in the near term or in the future. And are rates going to be cut by the Federal Reserve? I showed you that chart which illustrated how they've been raised. Once we have inflation normalizing, the Federal Reserve will be in a position where they could potentially cut rates. But what they've communicated to the markets and what the markets is pricing in is that we expect rates to stay higher for longer. So if you think about how the interest rate environment that we had before this most recent rate cycle, the Fed funds rate was close to zero. You weren't earning a lot of money on any fixed income investments across the board. And so what would trigger the Fed to cut rates quickly would be a very severe slowdown in economic activity and a recession. But that is not the base case, and that's not what the market's predicting. And in fact, I included in here and I can circulate this out. There's a lot of numbers on here, but these are the actual projections that were released in September from the Federal Reserve. And I think the key thing to look at is at the very bottom here, the Fed funds rate, because that's what a lot of the investments that you see in the Yamhill County portfolio are going to be keyed off of. So in 2023, you see we're at 5.6. 2024, the Fed is projecting only going down to 5.1. So very minimal cut. And then slowly normalizing over that long term to a 2.5% Fed funds rate based upon a long-term inflation projection of 2%. So I think, as I think about that for this portfolio, right now, the average maturity of the bond portfolio is about 1 year. So those bonds are going to start to be maturing here and rolling off the portfolio. And Chris is going to need to reinvest that capital. And it looks like these higher rates will be available to repurchase into for at least another year or so.
So I have a quick question on that.
Of course.
Under the federal funds rate, does that track with if we bought a 2-year? So we're in 23 now. If we bought a 2-year, the rate would be roughly a 3.9% return on that bond, or is this separate? This is just.
Yeah, that's a great question. The Fed funds rate is basically the rate that the Federal Reserve makes capital available to banks. And so it really ties more closely to the cash rate that you can earn. So in the Yamhill County portfolio, Chris, remind me that the investments that you have kind of with the county, what is that called? Not the Zion portfolio, but the
the LGIP.
Yes.
Yeah,
So
which is now at 5. Right.
Yep. So that tracks pretty closely to this. A 2-year bond, would be priced out based upon the yield curve. And so the short end of the yield curve is more tied to that Fed funds rate. And the rest of the yield curve fluctuates depending upon other factors. And as I said, in the most recent time periods that we've seen, that 2-year bond would be really close to that, 5 or so % yielding. Those longer dated bonds have been earning less. But I think, to your point, yeah, it's probably, not that far off to think that would make sense, but probably right now, the 2-year is going to be closer to 5.
If I may, Stacy, one of the things that enters into this is when I'm projecting or planning, I have to do the balance between if I can earn right now about 5.5% on a 6-month treasury. But eventually I'll only be able to earn 2 years from now. If this were to hold true, I'd only be earning closer to 3.9.
Right.
So at some point, I have to decide I'm willing to go longer terms so that my rates can hold higher for longer. But I don't have that crystal ball because the opposite could happen. I could buy a bond, not likely, but I could buy a 2-year bond, and 2 years from now, when that matures, and that's what I have to look at. What is the rate going to be? Well, it's going to be 3.9%. So do I buy a 3-year bond now in hopes that the rates, so it's, I stick with the short end because we're not really looking to max out our return. We're looking to keep our capital fluid and safe and earning a reasonable rate of return.
And I mentioned how you have that change in value, the price of the bond with interest rates going up. And the same is true in the reverse if interest rates go down. So for example, if Chris buys a bond, let's say it's a 1-year bond, or let's maybe extend it out, 2-year bond at 5%. And then rates are cut so that same 2-year bond is now earning 4% in the market. Well, the fact that Chris is holding a 5% bond in an environment where new issuance is being issued at 4%, the value of that bond will go, the price will go up. So it will be priced above par. So if she were to sell it in the market, she would actually get a capital gain on that bond. And most people think of income for bonds, which is the majority of what we earn is income, but there is a capital gain or loss component that you can get as well if you're selling those bonds before maturity.
Which we'd rather not do.
Which we'd rather not do. But you did do that
I did.
earlier in the year just to be able to shift into some higher rated securities. Okay, so
Go ahead.
just real quick, I want to just quickly touch on, are we going into having a recession? And of course, I don't have a crystal ball. The committee doesn't have a crystal ball, but just a couple points here. I think, overall, just to cut to the chase, my company's view, a base case view is not thinking about a recession in 2024. We don't think that that's likely. And the primary reason for that is because the labor markets continue to be strong and the consumer balance sheets are also strong, and they've been very supportive of economic activity. Now we look at things more nationally. I did include a slide in here from the Oregon Economic and Revenue Council, just kind of talking more specifically about a West Coast inflation, and they've kind of reiterated some of the points I've made here, that inflation is slowing, that the impact of interest rate hikes is still evolving as businesses and consumers have to pay these higher rates to borrow. But as noted here on this last bullet points, many businesses and many consumers locked in low rates when those were available. And so that has helped mitigate some of the impact of these higher rates. So in the interest of time, I'm going to skip over a few of these slides that just kind of summarizes what I just said. And so just to summarize the presentation, and I'm happy, Chris, to send this to you if you'd like to circulate it to the committee, is that inflation is trending in the right direction, although not yet stabilized at the Fed's 2% target. We think the interest rate hiking cycle is likely at its end or nearing its end, but we do think interest rates are going to stay higher for longer. My company believes the earliest that we could see rate cuts is the second half of 2024. Recession risk I just addressed. And then this last point here is what Chris just mentioned, that reinvestment risk, and kind of thinking about what is the rate environment like, and does it make sense not to extend duration or long, but is it better to have a little bit longer duration to have higher yields in the portfolio as we might move into an environment where rates are lower. So with that, any other comments or questions?
Mary has her hand up.
Oh, yes. Hi, Mary.
Hi, a question about the greater geopolitical situation that we're watching unfold. We're probably going to anticipate higher fuel costs, which will impact the county. And there has been talk for a long time about increased numbers of foreclosures, which would impact our general fund, things like that. Are these elements you're taking into consideration? This would be a question for probably Chris more widely when making these projections.
The increase in the cost of fuel is actually not definite at this point. There are people, of course, there's always people with different opinions, but there are some people who think that things have changed a little bit, that there are more countries, I should say, in the world that have gas reserves, oil and gas reserves, that weren't big players the last time we had this problem. So it might not be as bad as we might expect, but certainly it's going to influence all of us. There's also the other dynamic that 20% of the new car purchases right now are in fact electric vehicles. So we're kind of weaning off of our addiction to oil and gas. But of course, the industries are the biggest users of oil and gas, and as if they kick higher in gear, then we will have a problem. In terms of the foreclosures, I'm not certain that our local economy is going to be hit that hard in real estate, because we fortunately are not a hot market and we're not a cold market. We're kind of in between. Now, Portland would be a different story. Portland is got way too high. So it's anybody's guess what's going to happen to values. Now, if the values of our property hold stable, if we did have a foreclosure, at least we could recover the costs, although we can no longer keep the profit, which, if I recall, I don't think we did anyway. I kind of remember, Mary, you being insistent that we should be giving money back to people in excess. Am I correct on that? It seems like
what we did was typically we would sell for a public benefit, a social benefit. And so we sold for back taxes to a housing authority or, a city or a municipality. But the taxing districts got their piece of the back taxes.
Sure.
There were very few properties sold for market value.
right.
But
Yeah.
I'm just thinking, in terms of increased foreclosures, that would also increase, that would impact the county.
Right. Well, it would. There's no question. I've not seen with my crystal ball that that's going to be a significant issue for Yamhill County in the near term being 4 or 5 years. I think we're going to be okay. The biggest problem that will happen will be in areas where unemployment is going to go sky high, and I don't see that's going to happen in Oregon. Oregon's been holding fairly firm in terms of its unemployment. So it's my guess. What do you think, Stacy?
Well, I think so. So Mary, definitely higher fuel costs is factored into the inflation calculation. I was just going to throw up one other quick slide here, which wasn't in the presentation, but you can see how oil prices have spiked up. And, this chart doesn't even go through the most recent events that we're seeing in Israel. But the Fed Reserve's 2% inflation target is on a factor that's called core PCE, which actually excludes food and energy, which tends to go, bounce around quite a bit. So from an interest rate perspective and whether or not the Fed will continue to increase interest rates to combat inflation, I think that the oil spike will likely not push the Fed to increase rates because it isn't factored into that core PCE. But I think the other side of the equation is impact, to Chris's point, is impact on the overall economic activity. And if you have a sustained high level of energy costs, our economy is not as energy dependent, to Chris's point, now as it was in the 70s when the oil crisis really kind of pushed us into an extended poor economic environment, but it certainly can contribute to a risk of recession, those higher fuel and energy costs. People just, your budget as a household, if you're paying more to fill up your tank, you've got to cut back on other areas.
And people have been. It's amazing. People have been, the numbers show that people are cutting back on the amount of driving they're doing. And I'm not certain which techniques they're using. Mary, you have your hand up again. Or is that the same? Okay.
So, Stacy, my question was kind of around that the difference between the inflation that people are feeling in the household versus this core rate of inflation. And it seems like they've removed all of the factors that we are facing and paying for. And so I guess I'm wondering why the disconnect. And because if consumers are facing this very, very high rate of inflation between food, energy, housing, whatever, and it's been removed from core, essentially this could bring everything down. And I'm not sure why the disconnect, because if the consumer sort of what we're feeling, and you can see it at the end there, I mean, it's still very high, but if what we're facing pushes people to sort of retract their spending or cut down, or we start to see an uptick in foreclosures or whatever, or people aren't paying their property taxes, right? I just don't see how you can separate the two. I guess I'm not understanding why feds do this, but what we're seeing right now is that businesses are they've slowed in terms of investment. There's a significant fear going forward, but it's not just investment, it's the cash flow within our current businesses. So we've already seen this kind of constricting of economic activity locally.
I think those are really great points and great questions. So just on your last comment there, you can see this is not Oregon specific. This is how interest costs have risen on businesses. And, back in COVID period, early 2020, businesses on average were paying about 4% for short-term loans, and now that's at about 10. So that 6% differential is a headwind, for sure. So understand that. And that's why I think, recession risk, while it's not our base case, is definitely out there. To your question about inflation, it's kind of wonky, but I don't think we should interpret the Fed's focus on core PCE and that 2% target on core PCE as disregarding the economic pain that food and energy costs give to consumers. It's more that this component of inflation tends to be very volatile. And so the Fed, while I do believe they think about it, they don't necessarily target interest rates and interest rate policy on that figure, because it would just be, it would swing us around too much. And so you can just see how this light blue bar was high and then it was negative, and then more recently it spiked up high. That's because of that increase in the oil cost that I saw, the energy component. So it's just trying, their thought process is trying to distill the more volatile and part of inflation to the more sticky and longer term inflation, that core inflation that's harder to bring down. Now, one big component of this, though, is housing. I think housing is about 30, I don't have these figures memorized, but it's about 30% or so, I believe, of the core PCE. And that's calculated on, not just, cost of home ownership, but also cost of rents. And so that is a big reason why inflation, that core inflation figure was high. Does that help answer that question?
Yeah, it's just, I mean, it's kind of frustrating when we're trying to look at the county's investment portfolio and sort of the goals of that versus what we could be facing, quote unquote, on the ground, which could be a very different feeling. So,
Yeah, I'm sorry, didn't mean to interrupt. The biggest, and Stacy has pointed this out really quite well, the biggest dynamic I think that we're facing is the business interest rate. If we have, people who are in their homes who have purchased at these lower interest rates are going to be sheltered somewhat from the increase in interest rates. They still have to deal with all the other inflationary issues, which are huge, primarily food. But the businesses generally are on shorter term loans, and they come up for renewal. They experience shock. They've been down at, I don't know, 4 or 5%, and now they're going to be over 10%. That will put a business under. That will put a business under very, very fast. And that is where, rather than in the housing market, which is in trouble, but the commercial side of our county is in serious trouble. And it's too bad Jim's not here, because although he probably wouldn't want to talk about it, but I'm sure that he's having to do a lot of negotiating with people who have commercial loans through First Fed as these loans are coming due. And at the same time, he's facing the same squeeze that we are at Yamhill County, and that he still has a very big portion of his portfolio that is earning below current rates. And so he is anybody who is in banking in general, but if you want to talk to our county specifically, the next year to 2 years is going to be very, very difficult. And we can't have employment if we don't have companies. And if the companies can't afford the current rate of returns, then they're not going to be able to stay in business, not just here, but anywhere. Then we're going to have, we could ultimately have a recession. Now, everybody's very rosy right now about, oh, we're not going to have a recession because look, everybody's employed. We're at full employment. The rates are going up, but that is dependent on the current interest rates, which is why the feds have an incredible difficult job trying to balance that. And so it's not wrong to be worried about our future economically at all. And, and especially with what's going on in the Middle East, we've got, if we go into a full-blown war and we're involved in it, companies that are in the defense industry, of course, will do quite well. But we will, bottom line is, it's not going to help us out at all. Anything else? So we have, thank you, Stacy. Thank you. You know, I know this is what you do. You go around the world in the country and you do presentations for investors. And so you have the materials and the skill set to do a very good and thorough explanation of what's going on. And I really appreciate having you on the committee. So thank you.
Well, thank you.
Yeah. so
Happy to be here.
Yeah, and so going on to, we're gonna go to oh, this is supposed to be. What are you guys seeing? Are you seeing this?
The cash flow
Cash flow.
and investment
Oh, okay,
report.
all right, good, thank you. Okay. So for this last quarter, first quarter of the year, for the Zion portfolio, we're about 41 million. And the LTIP, we've been, if you add that all together, about 20 million. And on average, our US bank checking account is 1.5 million to 2 million. So this is pretty representative of where we are today as well, even though this was from last quarter. We have a total today of 62 million in funds as opposed to 63, which is what we had at the end of September. This is the time of year when our assets are at their lowest because we haven't started taking in the tax receipts yet. We will in a couple of months. This will be quite high, but it's not all our money. And then it will level out until we disperse those funds to the various taxing districts that are expecting to receive their portion of the tax dollars. The book yield, which is what it is when we have all the discounted bonds because of the low rates, is only 3.2% on the whole portfolio. And so our unrealized loss at this point was about 1.1 million. And that's down considerably because things have rolled off that are at lower interest rates, but also I did sell off a large portion of the really, really low interest bearing bonds. And by the way, it took a lot of courage for me to do that, but I felt it was the right thing. And it turned out that it has been, as the rates have continued to go up, our bond portfolio and those low interest bonds would have continued to go down and it would be hard to catch up. So I wish I could do more, but that's as much as we really should do. We actually had a little gain, $400. Yay. And the market yield, which is our portfolio adjusted for the market, is actually 5.3. So that's a very good yield on the current portfolio. If we were to sell it at those low, including the low earning bonds. Half of our portfolio is under 180 days, and our average maturity is 1. Our credit rating is as high as it, and our bonds is as high as it can be. And we have callable bonds of 24% of our portfolio. And this is a really important thing to talk about. When we have a restriction of 35% of our portfolio can be in callable bonds. Well, what's happening is that because everybody was burned, I mean, everybody was burned by these longer term bonds that were paying such low rates. Nobody really wants to hold a long-term bond if the market should turn and the rates go higher. The issuers of the bonds don't want to pay 5% on a 5-year bond because they think, well, interest rates could go down to 2. So they are building into almost everything that is in the market a callable feature. So in 6 months from now, if I buy a 6% callable bond, 6 months from now, they can say, oh, sorry, we're taking the money back. You can't have that return anymore. And then I would have to go out and invest in whatever the current rate was, which might be 4%. So that's a risk when you're buying a callable bond, is that you can lose that bond, even though it's been paying a really good rate. Apparently, and this is before I was around, there was a period, probably I would say 10, 15 years ago, where many people, including the LGIP account, went out and bought callable bonds that were paying very high rates of return, and they got called, and then they had to turn around and invest that money in really low paying bonds. And so even though there wasn't a loss, there was a loss of investment interest. So the state decided that this is not a good thing. And so they are regulating how much we can invest in callable bonds. It is up to us. We have the 35%. We could make it 50% if we wanted to, which I wouldn't, but we could. So at this point, I am restricted from buying anything that's a really high rate of return right now because they're all callable. And so it makes it harder. The best I can do on a non-callable bond right now is around 5%, which is what LGIP is doing. So at this point, it almost seems it's better for us to stay in LGIP than it is to go out and buy bonds, unless I can get, which I've been doing, the short-term treasuries that are paying 5.5%. But that's not going to last forever. Does all that make sense, what I just said? Because it's important that we compare apples to apples. If you see a bond for 6%, you go, oh, well, why isn't Chris buying that? Well, it's because it's going to get called back in 3 months or not. We don't know. So it's not really a longer term bond. It is more of a temporary long-term bond. We did buy $5.5 million worth of new bonds over the last quarter, and some of those are callable, but mostly not. And then we've had $10.5 million that have matured. They weren't called, but they were matured. So that's the makeup and the reasoning behind where we are right now on our portfolio. And you can see there that our portfolio mix in terms of overall strategy is very heavy in the agency bonds, 55%. And that's because those bonds are highest rated, best return that I can generally get. And of that 55%, they make up a big portion of that 23% of callable bonds. So my emphasis is still, as it was last quarter, on the treasuries. The treasuries I can get, like I was looking today, if I had the funds. I don't have the funds to invest today because we're down at our lowest part of the season on cash. If I had some to invest, I could today get a 6-month treasury that would be paying 5.5%. So that'd be 0.5% higher than what we're getting on LGIP right now.
Your 5.5 million of bond purchases, do you have an average of what the interest rate is? Would that track with the 5.3 market yield?
Oh yeah, it would be at least 5.3. The new purchases are let's see. Here's the new purchases. And I don't know how well you can see this, but they have, oh, of course, they don't have the interest rate on here. That's not very helpful. Okay, forget about that. Sorry. But yeah, I've been getting everything that I have purchased in the last quarter has been closer to 5.5. And I've been pulling up the yield of the overall portfolio somewhat. And then I've been really watching what's rolling off. And we're in a period now where not much is going to come rolling off. We don't have a lot of bonds maturing in the next 6 months. But when we do start getting those, all the ones that are maturing are going to be at the lower end and will increase our overall yield as we get higher yield bonds or just LGIP. 5% LGIP is a really nice rate for a almost no risk, completely liquid investment. It's very good. Did that answer that question, Kit? Okay, so that's where we are in terms of the. Let's see. Okay, this is the part that really matters to us right now, is this is what's happening with that in terms of return. Over the last quarter, we had 542,000 return in interest and dividends off of the portfolio. And that is split primarily, it's about, there's more on the portfolio, the Zion portfolio than LGIP, but it's almost, well, you can see it's 42% has come from LGIP. So I think that's very balanced. The 1-year treasury right now, if you look at that, is earning 5.46%. LGIP at that time was earning 4.8. That's now at 5. And so the returns are better than they've been for years, certainly better than since I became treasurer when they were at 25 basis points. And yes.
Oh, I was just, is it okay if I just make a quick comment?
Oh, absolutely.
So just as you can see, these benchmark rates that Chris has provided kind of indicates like that 5-year treasury at 4.6 was paying less than the 1-year treasury at 5.5. That's that yield curve inversion that I mentioned. And that it has moved pretty quickly in terms of, it hasn't completely reversed, but it is starting to reverse. So the 10-year treasury, I think today is almost at 5%, which is the highest it's been since 2007. So we are starting to see this inversion unwind a bit.
Yeah, which is great news for everybody. The difference still between the 1-year and the 5-year is significant. We are restricted to maximum maturity of 3-year in our portfolio. And right now, that's all on the higher side, but that won't always be the case. At least I hope not, for people's sake, because this is not really healthy, what we have now. Because if you have everybody turning over their cash investments over and over and over again, it makes for a lot of volatility, not just in the bond market, but also in the stock market. And, you know, we're not invested in the stock market. We're also not completely isolated from what happens there. But I feel really good about where we are right now. Not much happier to show you this than what I would have shown you a year ago. And so if we could, you know, get stable and stay at these kinds of rates, it would be great for the health of the county, financial health of the county. I think right now interest rates today, we're going down, stock market's going down. Who knows what all of this mess in Israel will do. But this is, I think, a really interesting, if you look at the rate trends from 9 of 2020 till today, and you can see inflation was at 1.4, then it went up to 8, now it's at 5, now it's down to 3.7, I should say. And then as you watch these lines on the rate trends, you can see that other than the, I always have a problem when they use all these same colors, but the LGIP has probably improved the most. And, but the 3-month treasury was only 0.09%. which is like, why bother? And now it's at 5.62. So for our purposes in the portfolio, this has all been very, very good. Just not good for the businesses who are having to pay these rates. We're on the receiving end. It's good. Are there any questions on this? I think there's, yeah. And then this is our earnings trend. And you can see it correlates with the low rates of return back in 2020. Or it went, the lowest was in 2021. That was my first year. That made me feel great. But now I project that we will earn at least 2 million on our portfolio in the current fiscal year. And a significant change. And hopefully will help the county balance some increase in expenses. Any questions about that? Now, one of the things that we have to be, and you as commissioners in particular, have to balance is the fact that this is public information. And if people see this and they say, oh, look, they're making 4 times what they did in 2021. They should be able to pay us more money. They should, look at all this money they're rolling in the dough. And because they don't necessarily have the understanding of the correlating increase in expenses, and I don't have that information. But I'm sure if we had that, it would tag along nicely. I'm just glad that we have earnings that can help with that. This is the what we bought, or what the trading, the buy and the maturity over the last quarter. And it's just pretty much normal rollover and maturity and buying to replace what we had in the portfolio. And this is where you get the interest rates. This is a complete description. And this is in order of maturity, a complete description of the bonds. And as you can see, this month we had quite a bit rolling off. We have 1 million, but then it will slow down. Then we'll have some smaller amounts, but I've tried to make it so that there's no big surprises. I'd like to see 1 million, 1.5 million, 2 million mature each month, and then I would replace it with whatever I could get at that time. And it seems to be working. Now, one of my concerns, because I'm a little bit working in the dark here about some of the things that are going on in the county, and I'm not complaining about that, is I want to be heavier on LGIP than I've been, because I feel like fluidity is really important right now for the county, for many reasons. I know we have things like the planning department's building that is no longer usable, and lots of big things going on. And I talked to Ken about that, and I said, just let me know as much as you can if you're going to have some big expense coming up, so I make certain that we're liquid enough to meet those needs. Does that make sense to the commissioners?
It does me. I'm still a bit concerned why, and the math may just not be there, why we're sitting on a 0.6, a 0.4, 0.5.
Those they will mature, but we take big loss. Look at the loss on, let's say, the one on 10/15/24.
Yeah.
Sold it, we'd have a $23,000 loss on that $500,000 bond. That's why. We really can't do that.
What's the math if it was immediately rolled into a 5.5 at the rate now?
That's what I did with in the beginning of the summer when I sold off some. And these are shorter term enough that you can't make it up. It's basically, it's a fairly, the market is very efficient. If the market, we have that, well, this one right here. If we have this and we have 500,000 invested in that and the $23,000 loss. And I went through this math the last time when we looked at this, and these bonds, if I sold them today, would not, they wouldn't break even. We'd have a loss still. It doesn't, it might be a small loss, but we'd have a loss. Now, if you recall, the last time when I sold, I think it was $10 million in bonds that were even worse than this, it involved a $600,000 loss. And that's a pretty big loss, as opposed to being patient and waiting a year. And then we will get all this $500,000 back and we'll get a higher rate of return. I understand your concern. I hate this. This is what every single finance industry manager, portfolio manager is dealing with. If you talked to Jim, if he were here right now, he would tell you he has a ton of these things in his portfolio. Everybody does. Is that your experience, Stacy?
You know, so I think a lot of our clients, yes, this is a short answer, but a lot of our clients who are investing with investment managers who are trading the portfolio a little bit more actively. So they've probably largely gotten rid of them, but at a loss. And I don't disagree with, given the short duration of these existing last bonds that are paying out at these lower rates, it makes sense just to let them roll off, get your par value back, and then reinvest at the higher rates versus selling now and taking the loss, because we just don't have enough time to get to a break-even point with recouping by investing in the higher rate bonds.
So is there fees associated with selling, just for example, this one that we're talking about under 1015 at the 0.625%, 499 minus the loss would be at 477. Well, if I took that 477, put it in a 1-year bond at 5.5, I'm at 26 grand. So I gained 3, unless there's fees associated with that.
No, there are no fees. I mean, they're background fees, but they're not fees that come out of
So is that just too easy a math? Am I not thinking of this correctly to where we'd actually gain 3 grand if we could wait, if we could sell it at a loss, put it in a new one at 5.5 and actually gain 3 grand if we can wait? But we're resetting the clock. We're going a full year now from, let's say, today, but could gain 3.
Well, you have to remember,
Approximately, it's 2,900 and change.
But I think it's callable, is what Chris said.
Okay.
yeah. If it's so you remember, we're only going to have 477 to invest, not 499.
That's right. And I took the 477 times 5.5. And it gave me 26,235.
26,235.
Right.
And yet we will have, oh, here's another thing that I actually didn't fully realize is that this is income, obviously. This income goes out and is dispersed to the depositors, which in this case are the departments. So what happens is if I sell this bond, this $23,000 loss gets taken back from the departments that this money is distributed to. In other words, like Health and Human Services, the last time I did this, they took back on the books $60,000 from Health and Human Services from their actual working income. And the that unevenness for them to have us doing that sort of thing is really not workable. The 600,000 loss was spread out on all the departments. And so it was taken away from their interest earned. So some of the departments actually lost interest last year because of that $600,000 loss. And you can't do that in a working budget. It's just not, it's not feasible for them. Nobody complained about it. But it's still a reality for them.
Yeah, see, and I understand the individual budgets for different departments, but I'm looking at it as a whole picture, and that's why I'm asking the question, just so I can understand more.
It's not, I absolutely understand your question, and these are the kinds of things that are worth looking at. But once again, when I talked to Jim, and I hate using him as an example because he's not here, is that he had been at a conference this summer with all the various banks and savings and loans, and the basic agreement among those people was that it was not worth selling those bonds if there's this short term. I mean, this is very short term. And but if you have how long, the real question is, how long does it take for this 477 to work back up to the par value of 499?
Right.
And if it was a year, as you're suggesting, and I don't doubt your math, there is it's, first of all, our investment policy says we can't do this unless there's, I mean, we're not supposed to. We can do it. We did it. But I don't know. I don't argue against your suggestion, but I would feel a little bit irresponsible to sell a high quality bond.
Right,
Even
and
if-
which is fine. I mean, there's a price to risk, and
Right.
the way that we're having this conversation sounds like it might be a little bit risky for what you're thinking, and that's fine. I'm okay with that. I'm just,
Yeah, no,
asking
I'm
questions.
glad you asked the question. It's not a disagreement. It's a discussion.
Yep.
That makes sense. If I went through here, now this is one of the unusually low. If we look at, and this is going to mature fairly quickly, the ones that, like this Apple, which is going to mature sooner, that's a big loss too. There's a few that are going to mature, and I'm glad that they're going to mature. But if we go down, we have some, well, here's one. You want to look at something that's really kind of scary, is this is 2.18. If we were to sell this bond, we'd lose $45,000. And that's a big chunk. Berkshire Hathaway, $41,000. All of these longer term bonds, which were purchased, I don't know exactly when they were purchased. I can guess by looking at the amount that I bought these when I first started as treasurer. These bonds were the best that we could get at the time, a 3.3, 2.1, 2.3. We don't know what the future holds. We could end up, if we go out longer than a year, we could end up with some bonds that are, this is one that was purchased recently. It's still 5.85 coupon. It still shows a $4,000 loss. It's really hard to predict it. Basically, we have $1.1 million in unrealized loss at this point. If we were to sell all of that, first of all, it would throw, I think, a lot of departments into chaos. But it also, would be great. It'd be very easy to manage. I'd just be rolling it over every 6 months because I wouldn't be, but then we might as well just put it into LGIP and earn 5%. I don't know. This is what I get paid the huge bucks for. is to wrestle with these issues. And I don't disagree with you. I mean, I at all. I just kind of, everybody who is in the business, like I said, is facing these same considerations, particularly because if I had to pay out money from these bonds, it wouldn't be enough for the people who wanted to invest. So I couldn't turn around. Like I noticed that First Federal has some higher returning deposits right now, but this is the worst bond crisis in recent years. If you go out and you look at money market funds that invest in bonds, those funds, a lot of them had big 20% losses in some instances last year. And that's because they did sell them. So I don't know. Anybody else have an opinion? Stacy?
I mean, I think, Chris, it's just kind of looking through your bond portfolio and, where you have these low yields where they are going to roll off relatively soon. I'm not sure it makes sense to go through the effort, but it might not be a bad idea to just, for some of these longer ones, to see if it does make sense to take a little bit more loss and get into some of the higher returning bonds, because the potential thing, as you said, if you're holding on, I think there was a 2027 bond that was the
Right.
one that you had
Berkshire
pointed
Hathaway.
out right there. Yeah. So that one, so you still have 4 year, well, I guess we're almost at the end of 2023, so 3 years of earning that lower yield. And then by the time it does mature, I think there is a good chance once we get out to 2027 that rates will have come down a bit. So your opportunity to reinvest that capital at these 5+% percentage rates may, again, my crystal ball is not perfectly clear either, but may not be here. So I don't know if there's limited opportunities where you have some of these longer ones to take a fresh look at that. And I would certainly, I have kind of wide expertise across a lot of different asset classes. I'm not a fixed income specialist. So I think, asking Jim his view as well, it might be a really good thing.
And I could do that. Last time I asked him, he said, don't sell. And then I sold anyway. So, but it's kind of like, going to your father and asking permission for something that you really
well,
want.
the other thing, like in my world of working with wealthy families, there's value in the loss because they can use that loss to offset capital gains in their personal income taxes. But that's not the case here. So that also is one reason why, I think my clients have been more active in realizing those losses than it makes sense for the county.
Yeah, I'm not opposed to doing it. Trust me, I love buying high paying bonds. Every day when I get all the information from all the brokers, it's like, oh, I want that bond. I want that bond. And then I think, oh, I can't do that because I'm trying to keep the portfolio liquid. Now, if I were, this is one thing about with this Berkshire Hathaway, if I were to sell that in order to get the rate of return that I would want, I would only be 6 months to a year out. So there's no guarantee 6 months to a year out that I'm going to be able to roll that into the same rate of return that I can today. So it's not a 3-year guarantee of 5.6%, whatever. It's a 6 month to a year guarantee that I'll be able to earn that. I think that interest rates will be high enough in the future that it will still make sense that when they roll over 6 months to a year from now, the rates are not going to be that much different. So we could continue to get that high rate of return. So, you know, I'm kind of a cowboy and I have to keep that under control because I would love to clear out all these low paying bonds. I would just be great and buy these high returns. But I'm not certain that it fits with our investment strategy, nor does it fit with being conservative, which is what I'm supposed to be. On a personal level, I sold my entire stock portfolio last April, every single stock I own, and put it in bonds. So I'm a big believer in bonds, and I just decided it was the right time, and it turns out so far I'm right. But you can only be right, 50% of the time at best. So I mean, I'm not opposed to making a big shift.
I've asked this before. What's our interest rate being paid on our checking account? We have
The
like
interest
a
rate,
million or so in there.
the way that works is they don't charge us anything for the services that we're using. And so they don't charge us, so they don't pay us as much. So our interest rate is probably less than, it's probably 2 or 3 basis points. But we save tens of thousands of dollars on the fees. There's a lot of fees that can be associated with, because we have a lot of activity that comes through there.
Biggest fee would be like direct withdrawals for employee paychecks, or I guess
I don't,
give me an example of the biggest fee associated.
I don't manage the checking account. That would be a question you would want to ask Mike
Mike, okay.
Hart and Ken. They would have a sense of, because I know it wasn't that long ago, I think, that they did an analysis on that account when they decided to continue. I'm not certain this is the right time for them to have to look at that. But I think that they would know. And there was a time when we were paying, tens of thousands, I think, in fees to banks. So it's negotiated all the time at some level. When I look at the statement, I don't see any charges. I just see a small amount of interest that is earned. Let me see if I can show you. A recent statement. No, that's not the one I want. So here's our most recent, or close to one of the most recent checking accounts. So we had 110 deposits. You can read this: 676 checks paid. Here's all the deposits. And it's just activity, daily activity. We have a merchant. I don't know what that is. Electronic. So all the items that go through Health and Human Services appear to come through here, as well as just payroll. It's not just payroll. And so there's a lot of activity that comes through this account. Now we have a separate account for the money that is collected through the tax assessor's office called the lockbox. And that is inactive most of the year. And then, of course, it's quite busy starting now and moving forward. But I don't see any. Let's get out of our way. I don't see any interest being paid on this particular. Anyway, so that's what it looks like. It's a lot of money that moves through there, a lot of items, and we don't pay for that. It's balanced out. And the lockbox is the same way. Yamhill Communications Agency gets like $1 or $2 every month because their activity is lower, so they actually get some small amount of interest. Is that helpful?
Yeah.
Okay. What was that? So we could talk about this all day, and we've already gone past our usual length of time, but I think it's important. I will look again. You know, Kit, you're like a little thorn, just kind of trying to push your way in here. And it's not a bad thing. I welcome this sort of input. That's why we talk. So I will look at it again, and I will see. Now interest rates are a little bit down right now, but they probably will go back up in, you know, certain days. And I can look at that, and I rather than do, last time I did a bunch at once, I could do one at a time, so the math is easier to understand. And as I said, I'd be thrilled to do that. Any other input on that? Mary, Lindsay?
No, I'm good, thanks.
All right. I just, and Lindsay, you're okay with me looking at that too?
Yeah, I'm fine with it. I mean, I think that it's clear that you've been analyzing this kind of stuff since the beginning, so.
Yeah, I have, yeah. You know, we had a different, like everything else, if we had a different board of commissioners, they might just be freaking out if I talk about doing something like that. And so the makeup of this board is helpful to me to be willing to look at stretching out a little bit like this. So thank you, I appreciate it. Okay, is there anything else for the good of the house today? Thank you very much. Thank you, Stacy, again,
Oh, you're welcome.
for your input. And you'll probably be hearing from me, and when you do, it will be one bond at a time. And but maybe 5 in a week, you never know. So, but thank you.
Thanks, Chris. Thanks, Stacy.
Thank you.
Chris,
Thank you,
thanks.
commissioners.
Thank you.
Thank you,
Appreciate
Chris.
it.
Bye-bye.
Bye.